Welcome to the Deep Dive. If you were a young American investor today, just trying to build a solid financial future, it is honestly exhausting. You open your phone and you're instantly bombarded, right?
Oh, constantly. It's overwhelming.
Yeah, you've got stock tips from influencers on TikTok. You've got panic headlines about the economy, Reddit threads screaming about the next big thing you have to buy right now. It's this constant noise that just plays right into our human anxieties.
Which is exactly why so many young investors end up making, emotional decisions. They buy at the top because of the hype, and then they sell at the bottom because of the panic.
Right, exactly. But today's deep dive is about stripping all of that noise away.
Yeah.
We're looking at what happens when you remove the human panic entirely and just let cold, hard math take the wheel.
That is the mission today. We are analyzing a really fascinating set of actual historical data. We're looking at the specific performance numbers and the under-the-hood portfolio shifts of three algorithmic investment strategies from Hush.
And these are the Protector, the Strategist, and the Adventure portfolios, right?
That's right. And we are tracking their exact behavior from their inception in the spring of 2024, right through this highly volatile period ending in March 2026.
Okay, but before we get into the actual numbers, we have to talk about how the system is built. Because it is entirely automated. These portfolios are powered by quantitative algorithms designed by asset manager and author Andreas Clenow.
Clenow is the architect of the system. He is the designer who wrote the rules, but he is not a human portfolio manager sitting at a desk, looking at your individual account and manually picking stocks for you every day. The engine is built on this mathematical concept called dynamic momentum. The system constantly monitors a universe of 80 carefully selected global ETFs.
Exchange-traded funds?
Exactly. And these 80 ETFs cover a massive footprint, different global stock markets, sectors, commodities, and bonds.
Okay, let's unpack this. Dynamic momentum. What does that actually mean mechanically? Like, are we just saying the algorithm buys whatever is going up the fastest?
No, not at all. And that's where the dynamic part is so vital. Mechanically, the algorithm measures the strength of the price trends across all those 80 markets, but it isn't just looking at sheer speed.
Okay.
It looks at risk-adjusted trend performance. It is measuring the actual absolute health of the trend.
So it's looking at, like, how bumpy the ride is compared to the return.
Exactly. If an asset is going up, but it's swinging wildly up and down every week, the algorithm sees that as an unhealthy trend. If it's climbing steadily with low volatility, that's a healthy trend, and then it dynamically adjusts the allocations toward those healthiest trends. It does this without using leverage and without shorting the market. It is purely hunting for healthy, positive trends. Performance must always be shown net of fees.
The numbers have to reflect what a client actually keeps after the fees are taken out.
Precisely. And furthermore, they use a double net benchmark comparison.
Right, because you have to compare apples to apples.
Exactly. And to establish our baseline today, the AOR is an investable exchange-traded fund.
Okay.
Its performance includes the reinvestment of dividends and is net of its internal operating expenses. Unlike a theoretical index, the ETF incurs transaction costs and management fees.
So just to translate, they use the AOR, which is a real ETF you could actually go out and buy as their real-world measuring stick.
Correct.
Past performance is not a reliable indicator of future results. All investments carry risk. Today's deep dive is purely an analysis of historical data, okay? It is not a strategy recommendation or future-oriented advice for your personal money.
With all those rules of the game established, let's open up the hood and look at the most conservative and the Protector strategy.
Yeah, the Protector. It's designed for exactly what it sounds like, guarding the core. This is for the young investor who wants the lowest amount of stocks and prioritizes lower volatility.
Right, and here is the exact historical data for the Protector. Its inception date was May 3, 2024. Its return since inception through March 2026 is 21.92%. The trailing one-year return is 17.89%. But here's where the narrative shifts. For the year 2026, the year-to-date return is only 2.21%. And in March 2026 specifically, the Protector experienced a return of negative 4.4%.
So what does this all mean? What exactly was the algorithm buying and selling to cause this?
Well, we have to look at the automated pivots. Between January and March 2026, it heavily increased its weight in FMF, jumping by 2.07 percentage points. That's a managed future strategy.
Okay, looking for alternative hiding spots.
Yes. It also increased ILF Latin American equities by 0.97 points. And USO, the crude oil fund, saw a 0.8-point increase.
Okay, so it leans hard into alternatives, Latin America, and oil. What did it dump?
It ruthlessly slashed its holdings in FLJP, Japanese stocks, and EWC, Canadian stocks. Both dropped by 1.32 percentage points. It also cut EWL, the Swiss market, by 1.11 points.
But despite those protective cuts, the overall portfolio still took that 4.4% hit in March.
It did, because global market drawdowns act like gravity. Conservative portfolios are mandated to hold a lot of broad baseline assets, so they get dragged down. But despite the dip, USO and GSG, a broad commodities fund, were positive contributors to the portfolio.
Okay, so that's the protector. It tried to weather the storm but still caught the gravity. What happens if we step up the risk? Let's talk about the middle path, the strategist strategy.
Right, the strategist is for someone seeking a balance between stock exposure and volatility protection. It has a slightly longer leash.
Let's hear the hard numbers for the middle-of-the-road option.
The strategist's inception date was March 15th, 2024. Return since inception is 26.84%. Trailing one-year return sits at 22.73%.
Noticeably higher baseline performance, which makes sense with more stock exposure.
Exactly. For 2026 year-to-date, it's at 3.46%. But in March 2026, it saw a drop of negative 4.36%. If we connect this to the bigger picture, it took a nearly identical hit in March as the protector, but it is outperforming it overall for the year.
Did it just buy more of the exact same ETFs, or did it make fundamentally different choices?
The directional trends were similar, but the magnitudes really shifted. For instance, ILF and FMF were both increased by 1.4 percentage points.
Right.
USO jumped by 1.02 points.
So similar targets, just heavier weightings,
Yeah.
and the cuts.
Even more aggressive. The cuts to EWC and FLJP dropped by 1.44 percentage points each. EWL was cut by 1.25 points.
Wow.
And again, USO was a powerhouse, contributing at 0.59 percentage points, followed by GSG, contributing 0.37 points.
Which proves the math validates itself across different rule sets just with the volume knob turned up. Which brings us to the highest risk tier. Here's where it gets really interesting.
The adventurer strategy.
Yes, this profile holds the most stocks and embraces higher volatility to chase the strongest trends.
Right. It has the absolute longest leash. The adventurer started on May 6th, 2024. Its return since inception is 29.85%.
Huge.
Trailing one-year return is 23.18%. Year-to-date for 2026, it's at 4.68%.
Wait. I have to stop you. The adventurer is the highest risk strategy, yet its loss in March 2026, the negative 3.72%, was actually smaller than the conservative protective strategy's loss of 4.4%. How does taking more risk result in a smaller monthly hit?
What's fascinating here is the magic of dynamic momentum when the constraints are loosened. Because the adventurer allows for wider allocation swings, it can adapt much more aggressively.
So it isn't forced to hold on to dead weight just to meet some safe quota.
Precisely. Let's look at the shifts. It made a massive 1.86 percentage point leap into ILF. USO increased by 1.22 points.
Just leaning all the way into the momentum.
Yes, and on the way out, it cut EWC and FLJP by 1.51 percentage points each. It also slashed VGK, the European stock market, and EWL by 1.36 points.
Just dumped the struggling developed world entirely.
Exactly. And because of that, USO contributed a staggering 0.68 percentage points to the portfolio, with GSG adding 1.42 points. The algorithm's ability to lean hard into these specific winning ETFs while ditching the underperformers is what buffered the March downturn.
So the riskier mandate paradoxically created more safety during that specific month. Looking at all three strategies together, it really reveals the core value proposition of algorithmic momentum investing, right? It's the total removal of human emotion.
That is the defining takeaway. And this raises an important question for the listener. If a software algorithm can dynamically dump falling assets and pivot toward emerging trends faster and with way less emotional baggage than a traditional human stock picker, what does that mean for how you, as a young investor, should spend your time?
Right. Should you be agonizing over the daily financial news or letting the math do the heavy lifting while you actually go out and live your life?
Exactly. It's a completely different paradigm.
It really is. Thank you so much for joining us on this deep dive. As a quick final reminder, all investing involves the risk of loss, and we are not recommending any specific strategy for your personal portfolio. But hopefully, we've given you a clearer picture of how this math actually works in the real world. Until next time, keep your hands off the wheel, and we'll see you later.